Hi, everyone. Thank you for joining us this afternoon. It's a slightly later one because we are here with our American guest, Rob, this morning, and I didn't feel like it was very kind to drag him out of bed at 3, 4 o'clock in the morning. So thanks for joining us this afternoon. Really appreciate you joining these events. And as always, if there are any other topics you would like covered, then feel free to drop us a note. We're always happy to cover a variety of topics and subject matters that are of interest and use these sessions are for you. So today's session is the reinvention of the US economy. Now, I've had the pleasure myself of working with Rob in the past, and I've heard him speak many times. If you haven't had the pleasure, then I think after today you'll be keen to hear more from Rob. Brilliant speaker, and the topics are really, really interesting, as I'm sure we're all aware that everything that goes on in the US is quite a fascination at the moment because there's a never-changing feast. And the topic that Rob's going to cover today is the reinvention of the US economy. So looking at the small cap world rather than sort of what we all know, we're all very familiar with the large caps, but there's a lot of potential within the small cap world. And Rob's going to do a bit more of an exploration around the US small caps and sort of dive into that a lot more. Now, those of you that have attended in the past, as you know, we have a Q&A button at the bottom. So I'd really encourage you to drop in your questions there, and we'll have sort of 10 minutes or so at the end after Rob's slides to go through those questions, and Rob should be able to sort of answer all of those. So Q&A button at the bottom, and session is recorded, so obviously that can be shared around and watched afterwards. But for now, I'm going to hand you over to Rob and for Alquity's presentation today, the reinvention of the US economy. Thanks very much, Rob.
Linda, thank you, and great to speak to everyone this afternoon. I do appreciate the little later start time from everyone. I'm speaking to you live from Boston, Massachusetts. Before I dig into the weeds on the topic that Linda mentioned, with a particular focus on small caps and what's happening in this reinvention of the U.S. economy, which of course, as we all know, is focused on AI. Just make some opening comments about they're kind of certainly obvious, but that we need to, I think, as advisors, as we advise our clients, pay attention to, and that's that. We're going through probably one of the most consequential periods in economic history and economic change, and also investment opportunity. The challenge is that that's wrapped, and I had an omelet for breakfast this morning, so it made me think of the analogy. It's sort of this incredible period of economic change and investment opportunity is wrapped in an omelet of chaos, right? Linda referred to the never-changing news story in the U.S., and of course, with social media, it's also a climate of sound bites and chaos every day. And our challenge, the hard part for us as advisors to our clients in developing portfolios, is trying to set aside the chaos. And that's what I'll try and do in my comments this morning, really focus on the opportunity and not the whatabouts that the chaos brings. And of course, that's the challenge that we have with our clients, is to get them to set aside the chaos and the whatabouts and focus on the opportunity as it relates to building long-term portfolios. So interesting, over the past year, not really much more than a year ago, the headlines were all about a slowing U.S. economy. Remember all the pundits, the growth cycle in the U.S. was over. The massive infusions of capital that came from the U.S. government around COVID, stimulus. Corporate earnings might have peaked. We started to see unemployment tick up, and there were lots of comments about what will happen next with interest rates and the decline in interest rates. Fast forward to today, no one's talking about recession risk. No one's talking about what the pundits were saying, gee, maybe 25 or even 50% probability of a soft landing recession outcome in the U.S. Now we're talking about innovation and an expansion of the U.S. economy that's really just getting started. And of course, we know the causes by that. It's fueled by innovation supported by massive injections of capital expenditures, which is really all about technology combined with energy. And we all know that story, right? It's the big driver that we hear about. Linda referred to it. It's the big companies, right? The Mag 7, they take up, and the other mega caps in this space as well. They take up 90% of the news coverage. But as we think about investment opportunities based on what's happening in the economy, and I'm speaking really about the public markets, you could do a whole nother session on opportunities in the private space. The punchline that I'll give now that we'll go through is the real opportunities that exist in what we call the picks and shovels of the U.S. economy, and that's dominated in part by smaller U.S. companies that are often overlooked. So we'll speak about that in some detail. At a high level, the returns in the AI space, and again, this won't be news to most of you, are not in AI product development, right? It's not in the development of products like ChatGPT at OpenAI or Claude or Copilot or Gemini. It's in the infrastructure. That's where the returns are that we're seeing. That's where the accelerating earnings stories are, is in the infrastructure that makes the product development in AI possible. And what do I mean by infrastructure? Well, infrastructure is the hardware, the software, the data center is really this energy infrastructure. And the demand for that, I mean, certainly there's news headlines every day that we hear about, well, when will we see return on invested capital? And is this company slightly cutting back on its capital expenditure? And that's bantied about. And that causes a lot of short-term volatility in the marketplace. But if you think about infrastructure on a longer term basis, the demand today vastly exceeds the supply. It's really a multi-year runway. I mean, just one example, memory demand will outstrip supply until at least 2030. You can't manufacture enough of it today for the demand. And that translates, of course, for the companies that are in that space, in the memory business, amongst others that we'll talk about, are seeing enormous demand, and that's driving revenue, which drives, of course, profitability. Before we dig into that in more detail, I just wanted to cover some of the macro drivers that you see in front of you on this slide. And certainly they have an impact on the market generally, but have an outsized impact on smaller companies in particular. So I'll certainly focus on the last one on the right, which is the AI box. But I did want to cover the others since they have such an important impact, particularly in what's happening in the small cap space. So in the upper left-hand corner, we talk about interest rates, and that was a really important tailwind, I think, up until recently. Now it's a tough one. It's kind of more of a mixed bag, and I'll speak to that. I still think ultimately we will be in for lower interest rates, just not on the near-term basis. I think that we had originally thought, or the marketplace had hoped. Remember, Jerome Powell, the previous Fed chair, was out. Kevin Warsh was coming in, a real dove. The market was talking about 2 to 6 rate cuts, right, in 2026. And I think that's probably delayed for some indefinite period. Maybe we'll get back to that. And that's because inflation is back on the scene. And inflation's been sticky in the U.S. It's been over 2% for 5 years now, was on its way down. Unemployment was rising, as I mentioned. Then tariffs started kicking in, the Iran war, AI spending, which actually is a positive, I think, on the inflationary front. And now we're stuck again at this over 3%. The good news here, as it relates to the Fed and their move on rates, is the U.S. economy is incredibly strong. So the Fed really only needs to worry about one side of the mandate, not the full employment side, but really just the inflation side. Now, for small companies, of course, those that rely on debt find themselves with a bit of a headwind with higher interest rates. But there are many excellent small companies in the Russell 2000 index that are doing really well based on current earnings and aren't that reliant on debt. And so that makes it a wonderful environment within that universe for active managers, for the real stock pickers. So summary: interest rates and inflation, kind of a mixed bag. We'll see what happens with, of course, the war with Iran being one of the primary drivers in terms of where does inflation head over the next 6 to 12 months. The second point is government deregulation, which is in the upper right-hand box, and we should add to that Trump and government regulation. And love or hate the guy, what doesn't make the headlines every day. So you read about all the Trumpisms, hear about them on a daily basis, which are juicier headlines around what's happening in the Middle East and other things that are happening in the U.S. What doesn't get a lot of play is all the work that's been done behind all the headline chaos on regulations in the U.S. And Trump and his administration has been very active at deregulation, which is a huge tailwind for smaller companies. Smaller companies are significantly burdened by the cost and time that it takes to comply with government regulations. So if you look behind the scenes, peel the onion back on what the Trump administration has done around regulations, dramatically cut red tape and regulations with the Food and Drug Administration, Environmental Protection Agency, not necessarily good, but in the short term, reduces costs. Occupational Safety and Health Organization, Department of Defense, the Small Business Administration, dramatic cuts in regulation, which are huge time savers, money savers for smaller companies. In particular, larger companies have the capital and staff to address them. Smaller companies don't. So this is a driver both in terms of time, speed of innovation for smaller companies, cost savings, which results in profitability, which of course can result in higher stock prices. The third one I'll cover, their tax policy considerations. Another thing that sort of faded from the headlines was Trump's big, beautiful bill. And what that was really all about were taxes and tax reduction, lower taxes. And we'll just start to see that in the coming year, because those lower tax policies, in particular for small businesses, the tax breaks were for 2026. So as we head into 2027 and tax returns, we'll see the impact of that lower taxation. And smaller companies, unlike larger companies, can't offshore their earnings. So tax relief is a huge savings and profit driver for smaller companies. And then, of course, the fourth one that we'll spend most of our time is AI, which came on the scene, like a tornado out of the Wizard of Oz in terms of the financial impact, the importance in terms of efficiency, innovation, product development, and all the things that are occurring as a result of the massive infrastructure spending. So the new conversation, I just talked about the fears that the U.S. economy was slowing. Now the new conversation is about this reinvention equation that I call it, which defining the equation, you have this massive capital expenditure, over $1 trillion a year, and that $1 trillion a year is expected to last over the next 3 years. So $1 trillion each year for the next 3 years. And that's infrastructure plus computing memory, which are chips, energy, which is data centers, electricity, transmission, and all that equals intelligence, innovation, and productivity. I mean, it sounds like almost something out of a science fiction film, that now energy equals intelligence. More energy equals more intelligence. And that results in innovation and productivity, which equals corporate earnings, which, all things going the way they should result in higher stock prices, in particularly for these picks and shovels, these smaller companies that we speak to. And of course, AI is not just about tech; it's infrastructure and energy. It's going to drive. You're going to see it across a lot of areas in society that also will bleed into these economic sectors, which is education, healthcare, sciences. So you're seeing opportunities there. And so a number of beneficiaries beyond just sort of the pure tech related companies. At this point in the presentation, the discussion, I was going to get into a little bit of a political commentary on capitalism and the rise of the democratic socialists party in U.S. government, but I don't think we have enough time for that. Maybe Linda, someone wants to raise that question when we get into the Q&A. Sort of what is this? What is the rise of some of these? I would say more extreme political views on the U.S. economy and capitalism and the impact that could have on this on the phenomenon that's occurring in the AI space. But or maybe that's for another webinar. But anyway, so now we'll get into more of the reinvention story. And Nasheen, if we could flip to the next slide. It's interesting. Over the past 50 years, the U.S. really has been focused on feeding people. And what do I mean by that? We have become incredibly efficient as a country with enhancements to agriculture, moving food products around the country, food safety. No other country in the world is more efficient at setting up the infrastructure to, especially given the extent of our geography, in feeding the country. Now, food quality in the U.S. with all our additives and preservatives is not necessarily the tastiest, but the government and industry has done a phenomenal job at making us one of the leading providers of food products around the world and certainly within our country. Where we haven't focused enough attention is feeding the machines. And what I mean by that is we've really starved our energy infrastructure, which is where we need massive and immediate investment. Now, you may say, well, wait a minute, don't we hear that the U.S. Is one of the, if not the leading exporter of oil in the United States now? And sure, we're great at producing fossil fuels and exporting them. What we haven't done is invest in the energy infrastructure, moving energy around the country. For example, our grid system is grossly under invested in, and we've had real problems in getting energy to different markets around the country. So that's why we're seeing this massive expenditure in infrastructure around energy. And the real tragedy would be if we had all these great companies, the Mag 7 that we read about, the OpenAIs, NVIDIAs, Anthropics, the Microsofts, building out all these AI capabilities, but the country's not prepared to capitalize on it because we don't have the infrastructure, and we lose out to China and others. So that's why you're seeing this massive multi-trillion-dollar, multi-year investment in infrastructure, which again, getting back to the picks and shovels, the smaller companies are important players. So just running through some of the numbers here, $58 billion, this should add up to roughly $1 trillion, around $58 billion in data centers. Data centers in space will ultimately be no joke because of water and electricity challenges in the U.S. So my guess is that's not going to be too far down the road, especially with all the not in my backyard resistance as it relates to data centers. We're seeing another almost $700 billion in semiconductor supply chain manufacturing. The U.S. has been so reliant on giants like Taiwan Semiconductor for importing chips and semiconductors, and more of that is being brought to the U.S. now. This is the onshoring and reshoring story. And then manufacturing jobs, almost 250,000 manufacturing jobs are in demand. And that's so important, getting back to my opening comments about inflation and jobs and the strength of the U.S. economy as we sit around 4% unemployment, which are record low numbers, and the job creation that will result of this reinvention of the U.S. economy, and 2/3 of the U.S. economy being consumer-led. So this full employment that's being created by this infrastructure spending is really important. As an aside, again, we talk about 2/3 of the U.S. economy is consumer spending led. With this massive infrastructure investment that will help balance out an economy that is so consumer-led, that will be as much industrial-led as consumer-led. So that really helps diversify and balance the U.S. economy. I often get asked, and we can go to the next slide, about, is AI a bubble, right? And that's in the news media probably on a daily basis. Is AI a bubble? We have a run-up in stock prices. So let's talk about bubbles for a minute, because it is one of the top questions that I get. If we look at bubbles throughout recent history, and how they've been defined, going as far back as the 17th century with the tulip bubbles, frenzy over really a single item, not even an asset, right? It's a perishable flower. The South Sea bubble of the UK in the 1720s, that was really an economic crash caused by stock speculation. One may say, well, gee, aren't we speculating on stocks in this AI world? But in the South Sea bubble, that was caused by promises of immense trade profits, lots of fraud, and no earnings. Contrast that with where we are today, where we have enormous earnings. We have the US railroad mania of the 1840s, again, speculative investment, not funded by the company's industry, but retail money, like today's meme stocks. Japan's asset bubble, that one may be more recent memory. That was when Tokyo real estate exceeded the value of entire countries, really speculative investments. You may recall Japan was buying up golf courses, hotels, buildings all over the US. And of course, that was a single asset bubble that burst. Even more recent memory, the dot-com bubble, anything with dot-com after it, that was all price, no earnings. So certainly that was a bubble that was prone to burst. And then, of course, the U.S. housing crisis, the GFC of 2007, that was simply lending money to people who had no money, and then securitizing those loans, bundling them, and calling them investment grade. So those bubbles all have a lot in common. They were single asset, pure excess, speculation, single industries, not earnings based. And that's a true bubble. Very different, I think, than what we're experiencing today. That doesn't mean that we won't have volatility, as we've seen over the past couple of weeks, most of it based on macro news, but the earnings story in AI is the real driver, and that remains intact. On a somewhat related note, before we start jumping into the top 10, I want to mention societal disruption. A lot of discussion around job loss at all levels with the advent of AI. I can't think of a time in history where this kind of advancement results in permanent job destruction rather than creates new ones. And then going back to a comment I made in the presentation, about 250,000 jobs over the next year being created within this industry. So this slide now, this is the top 10 of the VAM Small Cap Growth Fund underneath Alquity. And in terms of the AI comments that I just made, some of you is probably saying, yeah, okay, Rob, we know that story. What kind of smaller companies? Where are the stories? What are the names of some of these companies that you invest in? The whole AI infrastructure story, I think, is well spelled out on this page. These are the companies that are involved in the reinvention of the U.S. economy. These are the real picks and shovels. As you read down the list of names, some of them you may know, some of them in getting press, but most of them are not household names. What these companies are the recipients of the hundreds of billions of dollars that are being spent by the larger companies, because these are the companies that are building out the infrastructure. These are the companies that are generating accelerating earnings growth, in large part because a result of this massive need for infrastructure and the capital that's flowing into these companies. Now, you certainly see a lot of tech. It's about 40% of the fund is in technology, which is double the index. The index, the Russell 2000, is around 20%. But that's not because this is a tech fund. That's because that's where the earnings growth is within the small cap universe. The earnings growth, the accelerating earnings growth stories, is dominated right now by technology. But let's keep in mind there's another 60% to the fund that's spread across a variety of sectors: industrials, healthcare, consumer discretionary. But all of these stocks, all of these companies, whether they're technology or healthcare or consumer industrial, have some things in common. And that's, as I mentioned, real accelerating earnings growth, real cash flow. They're not over leveraged, so they're not big borrowers of those higher interest rates that we see in the marketplace. They're all part of this reinvention story. They're not speculative companies. They're not penny stocks. In fact, from a market capitalization perspective, while they're small company, generally within the Russell 2000, they're also multi-billion-dollar market cap companies. Not the trillion-dollar market caps, of course, that we see in the Mag 7, but these smaller companies with billion-dollar market caps. From an active management edge standpoint, why are there there are opportunities in the small cap space for active managers as opposed to just buying, say, a Russell 2000 index? And that gets to how does Wall Street and Wall Street research make money, right? That's based on volume, millions of shares traded. And that's one of the reasons there's so much attention focused on the large caps, the mega caps, the Mag 7, because that's where Wall Street makes money based on volume, payment for order flow, margin lending, rehypothecation of shares. And so there's less attention paid to these smaller companies. As a result of that, there's a couple of things that make good active management, a real advantage in this space in significantly outperforming the index, as well as good managers outperforming their peers. Certainly, it results in relative cheapness to the large caps because, again, less attention is paid because the volume isn't simply there. If you look at the Mag 7 today, PEs in the 30s, 40s, 50s. SpaceX doesn't even have earnings, right? So that's more on a price to sales basis of 137 times. If you were to strip out the non-earners in the Russell 2000, you have reasonable PEs in the 20s, which is where this fund is. The fund operates with a PE of around the low 20s. So this is truly a space for talented active managers. And while we're focused on the top 10 here, well-diversified portfolio, generally around 70 to 80 names. Let's just take a quick peek, if we can go to the next slide, at how the top 10 breaks down from an industry standpoint. I really love the niche stories around each of these companies and the roles that they play. You can imagine the kind of work by a research team, portfolio manager and research staff to really understand these stories and dig into them in ways that Wall Street research doesn't, again, because the volume simply isn't there. So the work's not going to be done by the big financial institutions, and that's an important part of the edge. But these are the picks and shovels of the reinvention story. And if you just we broke down the top 10 into percentages. You see about 20% in data center infrastructure, just to highlight one company in here, Lumentum, that makes laser components for computer networking, 3D sensing. In the industrial space, which is around 7% of the top 10. One of my interesting favorite picks in here is Everest Construction. Here's a fun fact for your next cocktail party. In the large data centers, and Everest is in the electrical construction business, and in a large data center, there are approximately 8 million miles of optical cable that's used in these data centers. So again, enormous demand for companies like Everest in this reinvention story. And then, of course, semiconductors. That's a part of the news flow every day. That's around 10% of the top 10 in the portfolio. And the real story there is we need to onshore, reshore semiconductor manufacturing, diversify away from suppliers like Taiwan Semiconductor, and that's where companies like MACOM Technology, who manufactures semiconductor components for chips, audio-visual equipment. So really interesting, diverse stories, again, back to the picks and shovels and infrastructure story of AI. And they're just under-researched. And what that results in are big earnings gaps between what Wall Street estimates and what the portfolio management team for the fund estimates. And there's often a big gap there, and that's the upside opportunity. Accelerating earnings growth and a earnings gap in terms of estimates between what the street thinks and what portfolio management thinks based on their own fundamental work. So now let's get into the proof statements, right? Because I can talk about the story, I can talk about the stocks. What are the results? So let's go to the next slide and take a look. This is the track record, 1, 3, 5, and 10 year for the VAM US Small Cap Growth Fund. And the story here, if you look at the bars on the left, which are the fund, real consistency over these time periods, beating the benchmark, not index plus returns, but real alpha generation. And that's capturing the gap between earnings estimates and street research. We can go to the next slide. So the manager for the Small Cap Growth Fund is now Oberweis Small Cap Opportunities. Previously, it was a company called Driehaus Capital Management, which was very successful. Driehaus, because of their success, had to close their small cap and their micro cap fund because, again, these are volume constrained companies. And when the funds get to a certain size, you close the fund. So recently, we hired a new manager across town in Chicago, same city, that follows a virtually identical investment philosophy and process with an important difference that I'll cover in a minute, but also showing exceptional returns over the time of management. Again, you can see in the left-hand bar the performance of Oberweis as a manager in the small cap space, producing exceptional alpha. Let's go to the next slide. In investing, the expression is it's not what you earn, it's what you keep. Now, I'm not saying this is an all-weather strategy. It's not a hedge fund. Doesn't make timing bets in terms of cash or securities. But if you look during these downdraft periods in the market, down 20 to 10, down 10, you can see that Oberweis has performed extremely well on the downside. And that's so important in a space such as small cap equities, where there is greater volatility than in large caps often, to help protect on the downside. And that's not because of some hedging techniques or going to cash. It rather gets back to this notion of quality, investing in the stocks with strong earnings growth, low leverage on their balance sheet, and avoiding the more speculative or companies that rely on debt, on leverage to finance their operations. And that quality bias significantly protects on a relative basis to the downside. That doesn't mean there won't be plenty of interim volatility if you try and look at a manager on a daily, weekly, monthly basis. But over time, Oberweis has shown, in addition to significant upside capture, exceptional downside protection as well. Okay, now let's move on to sort of the how to own. I often get asked the question, is now a good time? Should I wait for a correction? When do I get into the small cap space? Certainly buying on the dips can be opportunities. We're going through one of those periods now, but this is not a market timing strategy. So returns are lumpy in the markets in general. As we looked at our fund, the VAM Small Cap Fund, you can see that the returns are not spread out evenly over time, but lumpy like the market as well. And this goes back to the since inception of the fund. If you miss just the 10 best days, 7 of which occurred during major sell-offs, that would have cost an investor, since inception of the fund, £81,000 on a £10,000 investment. If you were invested on all days, you would have earned over £177,000. So this notion of a perennial exposure, not trying to time it, is important. Now, how your clients get into the fund, whether it's lump sum, dollar cost averaging, are important strategies to consider, but it's not an in and out market timed fund, but rather a perennial satellite exposure in a balanced portfolio. Next, we go to the next slide. We also looked at, well, what happens, getting back to this satellite exposure, if you just added, say, 5% to a traditional IA mixed investment balanced portfolio of equity and fixed income. So just 5% allocation adds a 16% additional return with only a 0.6% extra volatility. So again, demonstrates an important allocation of the fund to a portfolio. So moving to conclusion here, if we could, just again, this is an amazing period in investment history. I think it's an incredible opportunity, incredible investment opportunities that are emerging out of AI, particularly if you're investing with active managers who can do the research in the picks and shovel space. So hopefully this was helpful as you think about small cap investments within your portfolio. Doesn't matter who's in the White House. I wouldn't bet against the U.S. economy. And I think, if you want to learn more about the fund, certainly contact your Alquity investment sales professional. In this case, we have Steve Redaway's name up on the board, and you can learn more about the fund. And again, if you took a picture of this slide, you'd see the ISIN numbers, and the fund is available in GBP and USD share classes. So at this point, I'll stop and happy to take any questions. Linda?
Yeah, perfect. Thank you so much for that. Very interesting. The part that made me giggle was the shark ninja. I think my husband would have it that I was a sole reason why it's so successful because I'm a massive fan of the brand. My most recent purchase is a pizza oven. So
Right. The
um,
boxes show up every day. Yeah.
yeah, exactly. So yeah, there's some really good content in there. I think as well, quite often, I know when I was on the sort of side of the fence of the fund management side, having that story and that background around what's the makeup of the fund and, why you pick those stocks and the stories behind them, always sort of helps cement it in the client's mind. So I think some of those stock stories are really interesting. So we have a couple of questions
Sure.
around the sort of stock stories. Obviously, the fund is overweight in tech at the moment, which is understandable. You talked about, another one of your points is on the optical cable. I mean, they're kind of things that you
Mhm.
don't even think about when you're sat there using your Copilot or your Claude or whatever.
Right.
That all the stuff that goes in on underneath. So those stock stories are really interesting, and obviously that is at the moment understandable that you have this sort of interest in the tech side of things with AI. But one of the questions we had was about space and with everything that's going on in the press at the moment with SpaceX. Do you have any sort of views on that, or what are your thoughts around that sort of asset class?
Yeah. So if I'm understanding the question properly, so SpaceX, has been one of those interesting stories, and out of the gate, it came out with these absurd valuations. And of course, the company doesn't generate any profits today, but nevertheless, it's trading at this enormous valuation. And the belief is that valuation is based on a bet that the things that Elon Musk says he does. And so far, he has an amazing track record of that. Um, and this notion of data centers and infrastructure in space is not just some pie in the sky fanciful concept that the media likes to poke fun at and have play with. But data center, one of the reasons that we're less likely to have a bubble in the AI space is because data center construction is incredibly slow. The approval process, I don't know what it's called outside the US, but in the US we have something called NIMBY, right? Not in my backyard. Because these data centers are enormous, millions of square feet, need enormous amounts of water and electricity. So where do you put them? So far, placement for them, where there is the greatest amount of land, are in desert areas, which is contradictory in that we have water shortages and electricity shortages in those areas. So ultimately, whether it's data centers that are floating out in the ocean because of the coolant capability, or data centers in space, are not far-fetched, and there are enormous investments being made by companies like SpaceX to consider how do we place them in space. And that's why you're seeing this sort of inflated value in SpaceX, is that's contemplated as part of the valuation, is that we will see that that's not a Star Wars 25-year type of projection, but rather investments that will be made over the coming, I'll say, decade, that will
Mm.
find us with those kinds of capabilities, because it's just not, unfortunately, practical to do all the data center expansion given the issues that we have on the ground.
Yeah, and that obviously will bring opportunities with it as well, and different ways and ingenuity of sort of putting all the things they need, like the optical cable and everything else. So another avenue uh, of a different way of investing, and just a constantly moving feast, isn't it? And going back to things that sort of are tried and tested topics that we've all spoke about many times is US debt and Trump, and your sort of thoughts around on US debt and sort of Trump and the way he handles that, or how, his thoughts on that.
Yeah, it doesn't seem to matter who's in office, Republican or Democrat. The headlines that make the news are the U.S. debt ceiling, and that just gets, there are fights over will it or won't it get raised, and of course it always gets raised. And we've got a balance sheet with $40 trillion in outstanding debt. We've got $2 trillion deficit. each year. You think about that $2 trillion deficit. Well, we're spending $1 trillion servicing the $40 trillion debt, and then add on another $1 trillion in military spending. That's a real drain on the U.S. economy. And the debt servicing is a problem because it prevents the U.S. government from investing in all kinds of initiatives, because so much of our revenue generated through taxes is going to debt servicing, which is one of the reasons why there's Trump is so focused on expecting the Fed to bring down interest rates, in spite of the fact that we have such a strong economy, because we've got to keep the debt servicing costs down and reasonable. That's the government side of things. The important thing is that so much of what's happening from an economic expansion right now is being financed by the companies themselves. So private capital, or going to the credit markets, not the US government. And with all that spending and revenues and earnings, that's really helping to essentially finance the debt. So we have a balance there that's becoming increasingly important and helpful, which is the expansion of the U.S. economy to offset rising debt. So what that allows us to do is to kick the can down the road further, which we'll continue to do. I do fear for our children, and as this problem becomes greater and greater. But in the meantime, I think tax receipts will continue to improve with this whole reinvention story and economic expansion. So certainly a problem for tomorrow. Less so for today in terms of impact on the economy and markets.
Yeah, thank you. And then we had another question around, you mentioned and you touched upon, and it's something I'm familiar with from my time, when I was there actually with VAM, was the closure of because of the type of market it is, and foreseeing closing the fund as it gets larger because of types of assets. So
Right.
I think that's worthwhile sort of um, discussing how you manage that, because I think that's quite a
Sure.
useful point.
Yeah, this is a space where greedy managers over time can impact returns negatively.
Yeah.
So whether it's the VAM small cap or VAM micro cap, they are certainly both capacity constrained. They are open today, and Oberweis is our partner that manages the funds, and we have an exclusive relationship with them for distribution outside the U.S. And as part of that, they have guaranteed capacity for us. And even when the time comes to close the funds, they will be a soft close, not a hard close that we experienced with the predecessor manager. And what that means with a soft close is that if your advisory firm has invested clients in the funds, they can continue to add to those positions as well as for new clients. So I hate to sort of put in the commercial message, but if you have some investment in the fund, even when it closes, you'll still have access to it. And the soft close allows Oberweis, the manager, to continue to invest on a liquid basis in these small cap opportunities. But yeah, with success, with asset growth in these funds, there will potentially be soft closes in the future.
Yeah, I think like historically that's always been quite a long road, and sort of very openly managed, hasn't it? But it's something that does get raised with any type of small cap fund. So I think
Yep.
it's quite a valid question.
Yeah, and we're very
Um,
fortunate that we've got a small cap manager that's open, because many of them are closed. And Oberweis
yeah,
has been a bit of an undiscovered manager. The firm only runs about 5 billion, which is still a decent boutique firm, but only about 5 billion in assets. So room to grow.
absolutely. And then probably just to wrap it up, we can't really, sort of finish a US slide deck without touching on, future elections and things. So the midterms that are coming up in November, what do you feel? I know you haven't got a crystal ball, but what's your view on what they could potentially do to the markets out there?
Yeah, and Trump is certainly not helping the midterm election outcome with everything that's happening around war and inflation, right? Because what do they say? That investors, while they pay attention to all this, the crazy news out there, they ultimately vote with their pocketbooks, and their pocketbooks have gotten a little slimmer with pressures from inflation, especially as the war continues. What the market likes is stalemate. The market likes a split Congress, Democrats on one side, House on the other, because they prevent government from doing anything harmful, which is kind of a shame to say. I think Trump, even though he wants obviously the Republicans to prevail and at least holding on to the Senate, my own opinion, really doesn't care as much because we've got three branches of government, right? The executive branch, which is the presidency, legislative, which is the Congress, the House and the Senate, and then the Supreme Court, which is the judiciary. And what Trump has figured out through his own executive order process is that there really is only one branch of government that matters, and that's the executive branch. So, however, Congress is split or not come the fall elections, he's going to continue to do whatever he wants to do. And the markets, in a crazy way, kind of like that because they understand despite, the things that are happening that are at least on an interim basis inflationary, that he's going to continue down the front of lower taxes and deregulation and all the things that are stimulative to the U.S. economy, and how he's cleared obstacles out of the way for energy development, fossil fuel mining, et cetera, and the markets like that. So near term, whatever the outcome is of the elections, I think the markets will take comfort in a perverse way in Trump's
Yeah.
policies.
No, yeah, I'd absolutely, like you say, in a perverse way. It's interesting, isn't it? But thank you so much for that. It was really interesting. It's always great to hear from you. I think you made a point in amongst your presentation as well about putting a percentage. Now, that's the beauty of the platform. You can mix assets. You can have some DFM models with a proportion of some alpha generating funds. It's always worth bearing in mind. That's the beauty of the platform, is that you can sort of create these types of models and put some of this sort of alpha in if that's something that you or your clients want to do. So really appreciate your time, Rob. Thanks everyone else for dialing in. As usual, it has been recorded, so you'll get a copy of that recording. And our next presentation we've got a little slight break during the summer holidays. And the next one will be the 29th of September, which will be with Marlborough. More details to follow. If you don't already, please go onto our LinkedIn and subscribe and follow, and you'll get all the news there, our newsletters, information about the next webinars, etc. But all that remains is for me to thank you. Thanks so much for your time. Really interesting, Rob, and I hope everyone has a good day. Thanks for joining. See you on the next one. Thank you.
Thanks, Linda. Thanks, everyone.